Welcome to the daily update, where I'll go over the action in the market for Tuesday, April 2nd, and then we'll see how things look for Wednesday, April 3rd. We had a little bit more of a significant downward move in Tuesday's session. We're still looking positive in the bigger picture, but we want to respect what's happening right now. We are seeing some weakness come in, and this could even get to the point where it produces doubt as to this magical move higher that's going to happen no matter what seems to be really happening in the stock market these days. The market's put itself in a bit of a corner. If you remember back a few weeks, we had CPI and PPI, which both came in hot. That really threw the whole interest rate scenario into check, meaning that maybe the Fed's not going to be able to cut rates. And in fact, if we continue to see a lot of these stronger than expected reports, they may have to come in and actually raise rates. Then after that, you had the Fed come out, which came with this dovish idea that, okay, it looks like we're probably going to cut rates 3 times in 2024. And then last week, we had the PCE core report come in as expected when it's measuring inflation. And Jerome Powell gave a speech, which the market liked. Okay. We've been getting a series of economic reports that are stronger than usual now. And so we're seeing interest rates going up. There's also some tensions in the Middle East. That's pushing oil higher. And plus, we're coming off a really, really good quarter. And so you have some folks starting to lock in some profits. And that's kind of throwing this whole positive scenario into doubt. We'll go through the charts, we'll analyze them. We can only look at what we're seeing right now and evaluate things, and then just take it day by day. Before I get started, there's a couple of things to go through. I have just posted the second video about the proposed program that I'm hoping to launch in June. So now there's a part 1 and a part 2. Feel free to check that out. If you have any questions, I may be addressing a lot of these questions in other videos that I'm getting ready to post, but let me know. And if you want to leave a comment, that's fine. If you want to contact me directly, at the end of every video, I do leave an email address. Also, just to keep in mind, since I post a lot of different videos, and if you're coming across these videos and you're not really familiar with me and what I post, I want to just say that here's all the different videos that I do post each week. To me, the most important one is the daily video. That's the backbone of everything that I do. That's where my main analysis comes from. And then all of the rest of these videos are like supplemental. They just kind of feed into the daily video. I do a weekly video, an intermarket analysis video, so we look across the different markets. And then I do a deep dive video where I go through some of the charts that I really didn't talk about. And there are some charts unique just to that video. And then a new one that I started doing in 2024 is called What to Watch. And that's where I pull out the charts that I'm really focused on right now. But that doesn't necessarily give you the big picture of everything that we're looking at. The What to Watch videos is turned out to be really popular. And the reason I have an asterisk here, at this moment, at the time I record this, after Tuesday's session, April 2nd, I don't see a need to update that video yet. Now, if we have another down day and things really start to shift, and we are seeing some changes, then I will go in and actually update that. It's developing into a weekly video, but then it's updated on an as-needed basis. Another thing is, one thing I've noticed, and this is more of a fluke of YouTube, it's not so much for Rumble. When you leave a comment, I get notified of that. And I also get an email, and that's fine. The email can be kind of delayed sometimes, and then I respond back to that comment. And then if you respond to my response, I don't get any notification for that. So there's no email. Sometimes it may take some time for that comment to actually show up. And so there may be a delay in my response to your response. So I'm not ignoring any comments or replies that you might make. I just may not see them for a while. So I just want you to be aware of that. All right, let's go back and talk about what happened. Things were quite negative. We had a gap lower open. We opened below S1 at 52.27. We quickly went down below S2 at 52.11. See, we're dealing with that 5,200 level again. And we ended up finding support just a little bit above the 20-period moving averages. And that's what we've been watching for. So far, we're still above that. And as long as we can stay above that, this is looking like just a pullback. As the day went on, we chopped higher. That's rather encouraging. You have some folks coming in and doing some buying. We got back above 5,200, but we ended up closing below S2. We were down 0.72%, still less than a percent move, but compared to what we have been seeing, it looks like it's a lot more of a robust move. We're still below average with volume. That's kind of interesting. Personally, I thought after the holiday, and if we start really going down, we would see a pickup in volume. Now, you can take that a couple of different ways. The smart money's just laying back and letting all the amateurs do what they want to do, or the smart money's not necessarily concerned. And so they're just waiting this out, and it will get to some point where they say, okay, we've gone down enough. We're going to come in, we're going to start buying and push prices back up. So we can run both of those scenarios at the same time. Our technicals were positive in the bigger picture. We are showing some signs of weakness. There are some indicators that are switching over and looking negative. So we want to respect that and be aware of those things and see where it develops going forward from here. And it has to do with inflation and interest rates. Interest rates are really going up, and that's pressuring stocks. The dollar's going up, and that's pressuring stocks. Oil, which can go up with the stock market, it's going up, but that's more for geopolitical reasons. There's some tensions going on in the Middle East. And then inflation. Now, we're going to get the big employment report on Friday, and we'll see if the market likes that or if it's going to feed into this kind of stronger than expected economic report season that we've been going through. Some comments. It's still looking like a pullback to this point. Now, there's the perma bears that are like, this is it, baby. We're getting ready. We're going to tank 50% decline, 75% decline. We don't know that yet. Anybody can declare anything they want to declare. We look at the charts, and that's how we reach our conclusions. Oil is rising, and because there is some tension going on in the Middle East, and that's probably going to continue. There's some things that are going to be happening in Israel later on in April. There's their Passover feast, and there's some additional things that may be happening during that time. And this is already a very tense area, and the fact that that could even get even more tense is rather concerning. Plus, there's some things going on in Syria and things that have been going on all around in the Middle East. We just have our stochastics now. So we've worked off all of the short-term extreme positive or overbought conditions that we have. The stochastics, especially the long-term stochastics, it takes longer for that to actually move. And we already have an oversold indication. The Stoch RSI is extreme negative on an intermediate term basis, also a shorter list. Our oscillators are still not really quite sure what to do. They're just pretty much flatlining, but they're still at very high levels. But they're not really moving right now. The Sean trend meter is flat, but it's still extreme. And the bullish percent index, it's extreme, but now it's starting to turn down. So that's a little bit more negative. And then we still have our 150 and 200 moving averages that are extreme positive. The parabolic SCR, and if you've watched these videos for any length of time, this is an indicator that I consider it to be one of my primary indicators. This is now switched negative. The dot has changed on top, and that is a warning sign. We're still going with this basic scenario, but we're wondering, is that going to shift? Because we're seeing some tensions in the market that may be bringing this scenario into doubt. But for right now, it looks like the Fed is done raising rates, and they could possibly cut rates 3 times in 2024. The dollar was up and interest rates were up, and we're really going up here. We're at 4.37%. That just keeps going up and up and up, and that's pressuring stocks. We still have our yield curves that remain inverted. Sentiment is still positive. It had been at 72. With the down day, it ticked down all the way to 63. When we're at 50 or above, we go from being neutral over into positive. And even though we're positive, you have to look at the context. We're coming down as the market has been coming down. Our trend is still positive for right now. The ADX is weakening. It's really having a hard time to determine, okay, do I want to get stronger as a trend or weaker? And so it's trailing off, basically getting weaker. But we're still in a trending environment because we're above 20. The bias is negative, and now I've changed our momentum. And bias is up day, down day kind of a thing, where momentum is the last 2, 3, 4, 5 days taken together. I've changed that over to mixed because we're coming off of a really positive time. And since we're declining, but we're not seeing greater than 1% declines, I'm still keeping that for mixed. And incidentally, if you're new to these videos, this is the only area, the bias and the momentum. These are the only areas where I put my own opinion into what's actually happening. I try to let all of the charts actually tell us what's happening. So really the conclusions are made for us. The economic reports that came out, not a big one in that regard. Factory orders were up 1.4%, greater than the 1% they had expected. Last time they were down 3.8%. And we did get the jolt to job openings. I think I said the only report. We also had this one. That's ticking up a little bit. This is just the number of jobs that are out there at 8.756 million, up from the 8.748 million. So it's coming down because we were well over 10 million there for a while, and we came down into the nines, and now we're into the eights. And so there's still an awful lot of jobs available out there. Here is the factory order chart year over year, where we're coming back up on a year over year basis, but we're not that far above the zero level. Here's the job openings, a little bit of an increase from the reading that we saw last time. And then this is looking at the US heavy truck sales, where there tends to be kind of a correlation. When we see this going up, like it's going right now, that tends to be better for the economy because they're buying trucks, and you use those trucks to deliver things that people buy. And the more trucks you buy, the more jobs there needs to be the people to drive and maintain those trucks and load them and unload them and so forth. So this is still looking pretty solid for right now. Then we look at Happy New Month. Okay, now a lot of these charts were created, and it's interesting. We have some up days, and all the charts are happy and positive. We have a couple of down days, and everything's doom and gloom. So, there's a real sentiment for what information is actually posted as well. But this is a long-term look at the chart, and we're above the 10-month moving average. And I'll talk about long-term, my goodness, and we have price above that. So we go all the way back to the year 2000 and see where we're at right now when you take a bigger picture look, and it is still positive. Also looking at the ISM manufacturing compared with the S&P. This came in hot, and this is one of the areas that the market's like, well, wait a minute, this whole interest rate thing may not happen the way we thought. The purple line is the S&P, the yellow line is the ISM manufacturing. Now we're going to get the non-manufacturing in Wednesday's session. That's services. And that is a very influential report as well. And what we've been seeing here is these tend to go in the same general direction. Well, there's been a disconnect. And now we're seeing this coming back up. And that's good economically, but it was stronger than what the market thought was going to come out. And then the purple line, it's been going up, but now could be coming back down. We want to wait to see over a period of time, and it takes a while for this to develop. Are these going to come back closer to each other? Even though they're on different scales, is our stock prices going to come down? Is the ISM manufacturing going to continue to go up, or some kind of a combination of the two? Then I just found one chart on, there's a lot of really confused people on Twitter right now who they speak as though they have all the answers, but when you really look at what they're trying to say, they're like, I don't really know what's going on. This is looking back more on the happy times, consecutive trading days with the S&P higher month over month. We've had 97 days on a month over month basis. This is the 9th longest streak on record. Then we are keeping an eye on Alan Remenick. Don't know how to say his name, but this chart's now a few days old, where the move down that we're seeing, that could be what we're seeing right now. And then we might hit some kind of a bottom around here according to these cycles, and then bounce back up going into about the 10th of April. And then we'll see some weakness going into the latter part of April, and then chop our way back up until we get into the latter part of May. I don't know if there's anything to this or not, but for right now, the market's kind of been doing what these longer term cycles are suggesting. Here's our intraday chart. Just boom, we came down below S2, and then we actually broke below the 5,200 level for a while. We found some support just a little bit above the 20-day moving average, and that's when we set the low for the day, and we chopped our way back. We were able to get back above 5,200, but we never did get back up to S2. Here's also the intraday chart where the futures were trailing off just a little bit. They were looking kind of positive, but then they were even negative going into the cash session, and then a little bit of a bounce at the end of the day. So there was some buying that did come in. We're still looking a little bit better when we look at growth to value. And now we have to ask ourselves, okay, it looked like maybe we were shifting to another scenario where value could do well and growth could do well at the same time. But if interest rates are going to go, if these economic reports are stronger than expected, and that's going to throw the interest rate scenario into question, we might be going back to this growth to value type of analysis. And for right now, even though they were both down, growth did outperform on an intraday basis. And we did outperform virtually unchanged when we look at the ratio. But when this goes up, that means growth outperforms value on a ratio basis. Here's the end of day chart where growth was actually down a little bit more than value for the large caps, down, but down less for the mid caps, and down just a little bit less for the small caps. So we see red across the board. I like to point this out too. The middle area, these are the corresponding ETFs, and then they're broken down to value and growth on both sides. We are falling off with our growth to value ratio with the small caps. We saw a nice little breakout. Now we're falling back. That is a concern. We're also pulling back with the growth to value ratio for the mid caps. We're ticked down just a little bit when we look at the S&P growth to value ratio, but it's still positive for right now. We're coming down when we look at the discretionary to staples ratio. This is showing some real weakness right now. Tesla is just really having a difficult time. Large cap growth was down, but if you look at this in the bigger picture, we're still above all of the moving averages here based on price, and the moving averages are still going up. So the longer term trend is still intact. Looking at our trend, we are trailing off with the ADX. We're below the moving average. The green line's on top, but it is declining. Also, the green line is declining, and we're trailing off in the short-term ADX chart. We continue to be below average with volume. Here's a sentiment chart that I haven't run across before. It's put out by Yahoo Finance. And I don't know if I'm going to say this right. Levkovich. Who knows? Forgive me if that's your name, but this is just another way of measuring sentiment. And we were getting to a pretty high reading up here when we get to this red and blue line. It just means that we're getting a little bit extreme. This has not been updated yet, but the latest reading had us at 3.99. Hopefully it will be updated for tomorrow's video. We are going back up with the VIX. We come back above this upward sloping trend line. And even with the bar chart, we closed in the middle of the bar, but we are increasing with the VIX. We're seeing volatility picking up. We were getting very, very low readings here, and that's usually a cause for some concern. As we've been going down, we're seeing the VIX of the VIX also continue to go back up. We're no longer in the red area. Maybe this is the big move that the market had expected. We were up here, and we didn't know if this was going to be an up move or a down move, and we stayed up in this area for a while. We've now dropped below this. We'll keep an eye on this. We could go back up into the red area, or we could continue to drop. And we're turning back up with the momentum of the VIX, and we're starting to cross back above the moving average. As the VIX has been going up, the MACD is picking that up. And these still haven't been updated. I don't know. Maybe it takes longer than the 3 days to resurrect when you're at the CBOE, but we can just assume that the equity put call ratio is going up, even though these charts haven't been updated for a few days now. And we're probably going back up with the 5 period, but that's purely a guess on my part. We are picking up and starting to get out of this band with the volatility risk premium. And when we're going down, that's when we see this going up. And that just means there's more volatility in the market. We are still looking okay when it comes to volume, but we turned down with the advanced decline line based on price, but we turned down a little bit less based on volume. That's something that I've been really focusing on lately. When we're up, are we up stronger? When we're down, is volume down less? And so far, that seems to be happening. We're still at the top with our 5-period new high, new low study. We're trailing off, saw a little bit of an expansion of the new lows, a little bit of the red line there. And we're flat to starting to decline with our 10-period moving average. We're still positive, even though we're falling back with the advanced decline ratio. We've kind of broken below this series of higher lows that we had been setting, but we're still above zero. And accumulation distribution is still just a little bit below the moving average. Chicken money flow actually ticked up just a little bit. It might have picked up some of that later day buying that came into the market that got us up off the lows, but we're still negative with this indicator overall. We also ticked up a little bit with the chicken oscillator. And then this is what I'm talking about with volume, where we declined based on price with the S&P. We declined, actually, it looks like it didn't decline quite as much when we look at volume. With our advanced decline line, since we had the down day, we're declining with the NYSE common stock, the S&P mid caps, and small caps are pretty much back where they started a little over a week ago. Here's our daily chart. We're coming down to this pivot point. Now, this is a March pivot point. We're coming into an April pivot point. This could be providing support, and so far that has been holding. On the bottom, we are still below average with volume. Here's the Stoke RSI. Just a few days ago, it was extreme positive. Now it's already gone extreme negative. And here's the 20-period moving average. And I've been trying to point this out for quite a while. We're well above it, and that's positive. If we see some weakness, so far this level is holding. That would suggest a short-term pullback. Now, if we start to break below this, not just on an intraday basis, but if we look to close below this, that's going to turn this into something a little bit more severe. But for right now, these levels are holding. And also looking at our 20-period simple moving average of the open, high, low, close, we're coming down into this mini rainbow. And so far, this could be providing some support. We're no longer extreme with the 20, 50, and we're still extreme, but coming down with a 200-period exponential moving average study based on the S&P. We declined a little bit with the force index, but we're still positive. Our short-term stochastics is no longer extreme, coming down but still extreme in the intermediate term, rolling over but still extreme in the long term. And we're just above the midpoint in the standard deviations chart. That's another thing that we'll be watching. You notice other times when we saw some weakness, we came down and either it acted as support intraday or we were able to close above the midpoint. If it looks like we're going to come down and close below the midpoint, that's going to turn things more negative as well. Intermediate term, we are looking more negative with the balance of power. The go, no-go system is switched over to a lighter shade of blue, so that's more neutral. We're still above the midpoint, and this is providing some support too with our highest high value chart. And TTM squeeze is turning back over to a darker blue. That's more negative. And we're declining with the ease of movement, but we're still above zero. We were flat with the Arun, but after giving us an extreme positive reading, it has been coming down. We're still positive because we're above zero. We're dropping more with the McClellan oscillator for the S&P. So this is turning more negative. We're starting to turn down based on price. We're turning down, but not quite as strong based on volume. We're dropping below zero. We were positive after Monday. Now we're below zero after Tuesday with the NYSE McClellan oscillator. So now we're starting to turn down based on price, but we're still actually going up based on volume. And the Swenlin trading oscillator, turning down and looking a little more negative based on price, but still above zero. Turning down, but not looking quite as negative based on volume. Oscillator's not really helping us right now. We're dropping below the moving average based on price. We're still above the moving average based on volume. We did see some weakness with the PMOs that are rising. The buy signals are now declining. We're still extreme positive and flattening out with the PMOs above zero. We remain neutral with the Elder's Impulse system for the S&P. And this is kind of positive, even though we gapped lower, we came down, set the low, and then closed pretty much at the intraday high. That could be taken as positive. Here's the negative side, though. We have the parabolic SCR. Now we're drawing a dot on top. That is turning intermediate term negative. The slope oscillator, not really helping us right now. The MACD looking a little bit more negative. All of our oscillators, now they're tilting more to the negative side, but we're still really flatlining here and still giving us really extreme readings. So the oscillators, they want a trending environment. And even though we've been going up, we've been doing an awful lot of chopping. And that's why we're not really getting a lot of use out of our oscillators currently. Here we are still above the plotted moving averages on this chart. Now we're starting to come down with the bullish percent index. So now instead of going up and we have more of a positive stance, when this is coming down, it's more of a negative stance. If we drop below 70, that will make us even a little bit more negative. And if some point in the future we get all the way down to 50 and drop below that, that's much more negative. We turned down a little bit with the NYSE bullish percent index, but this is not giving us an extreme reading. And we're coming right down to the 50 level with the NASDAQ 100 bullish percent index. If we drop below 0, there's 50, that's going to turn this negative. We came down, but we're still above 50 with the money flow. We're dropping negative now with the ultimate oscillator. We are positive with the vortex, but we're continuing to drop. We could come down to this line and actually turn negative. That would be negative sign number 1. Negative sign number 2 would be if the red line comes up and crosses above the green line. We're still looking okay here with the RSI 14 and 9. Most of the recent readings going back to the first part of November have been above 50. On-balance volume continues to be above an advancing moving average. And with the stocks above their 20-period moving averages inside the S&P 500, after giving us a really high reading, we've now seen 2 down days, longer-term negative divergence here. We had been showing some improvement, and that seems to be in question now. We're also seeing a little bit more weakness with the 50-period moving average study, also a longer-term negative divergence. We're still looking okay with our 100-period moving average study. Yeah, it's coming down, but we're still up in this really high area. Also coming down, but in a really high area with the 200-period moving average. Then the Copic curve, take your pick. It's flatlined right now. The Sean trend meter is coming down, but it's still extreme positive. We're turning a little more negative on a trending basis with the Heiken Ashi. We now have a black candle. We're actually negative now with the Keggy. This is turning red and pointing down. Renko, it's still partying on like it's 2023. We're turning a little bit more negative here with the 3-line break with the black candle. And then we're looking at our short-term chart. We're below both of these lines. If we don't come back up to this, I'll probably drop using this chart until something else starts to develop that we can focus on. We're still above this resistance level, wondering if we continue to fall, will this provide support? I'm still calling it resistance because this didn't happen all that long ago. And until this really gets tested, we're not going to know if that ends up being support. We're coming down, but still extreme with our 150 and 200 period moving averages. We've changed a little bit with the small caps in the short term, turning to negative with the Keller market model. And there's another chart I'm starting to include here that's part of the Keller market model. Bonds based on price are negative across the board. Commodities in the long term are still negative, where we're seeing some improvement in the short to intermediate term. And no real changes here. I guess they're going to keep it negative now with the decision point scorecard. A lot of red, a few blue or green here, where we're seeing some weakness, where the S&P did get back below 5,200, but we were able to recapture that. Oil is causing some concerns. And as I said before, it's why is oil rising? It's because the companies are making more money. That's positive for the market. But if oil is rising because things are falling apart in the world and there's geopolitical things going on, that's negative, and that can put some pressure on the markets. Equal weight, underperforming just a little bit, but pretty much hanging in there with the S&P 500. So we saw our ratio going back up where the big stocks held up just a little bit better than the broader market. We are coming down below this pivot with the Dow. We're still above the 50-period moving average, and we're still above this S1 support level. But we've changed over to negative now with the diamonds for the Elder's Impulse system. And we're below this pivot point that had been providing some kind of support. Now, if we continue to fall, we have the 50-period moving average and this S1 level that may end up providing support for the NASDAQ. And we're dropping below this pivot level on the NASDAQ 100. We also have the 50-period moving average still below current prices. We've turned over to negative with the QQQs for the Elder's Impulse system. We are negative on a trending basis for the NASDAQ 100. The Qs did close below their 20-period moving average. A few weeks back, we were able to bounce up off of that. That didn't happen this time. We're pretty much on the 20-period moving average. So we could still recoup that, but the fact that we came down below it, spent most of the day below the moving average. And I guess you could take this as positive that we technically haven't really broken that yet on a closing basis. Small caps back to the old frustrating scenario here where had a great week last week and now have more than given that back. And we've switched over to negative with the Elder's Impulse system for the small caps. And I like to point this out. I don't trade myself in the small caps. I use them to get some clues as to what's happening with the S&P. Everything I do, all the strategies I implement are in the S&P 500. I look at all these other areas to get some clues as to what's happening across the market. Here's the Russell 2000 small caps. We're dropping below 50 with the RSI. We did decline based on price. We're still in a longer-term uptrend, and we're still above the 50-period moving average. The momentum had been turning positive. Now it's starting to turn back more negative. The mid-caps did close slightly below this pivot level, and we switched over to negative with the Elder's Impulse system for the mid-caps. Apple continues to be in a decline. Tesla is just running out of juice here, down 4.9% and in a downtrend. The FANG index, it's coming back more into the middle part of this sideways range that we've been in. The financial sector was down, but still is in a longer-term uptrend. The dollar continues to show some strength, and we're seeing a recent golden cross here. This is probably also pressuring stocks. I want to bring up a chart of oil. I usually save this for the intermarket analysis video, but we're really going up now as some geopolitical tensions arise. It's too bad. There were a lot of people. I was reading through some posts, and they were into the high 70s, and they were starting to short oil because they brought all this logic together. Well, this is going to happen, and this is going to happen, and A plus B equals C, which means oil's going to go down. And they just been getting decimated as it's been going up ever since then. I'm not making fun of them. It's what I'm trying to illustrate is that we can apply all the human logic we want to the market, and we can think we have it figured out. And we can think that we can put the market in a box, and then the market does something completely different. My opinion is look at the charts. They tell us everything the market knows about what's going on, and we need to follow the charts. And if we go against the charts, we're going to get burned. All right, looking at the S&P versus the world, we're seeing a little bit of a pullback with our 10-day correlation and flattening out with our 50-period correlation. Interest rates continue to go up. Yeah, they closed well off of their highs, but this going up is really concerning the market. And so we're going down based on price. And we're not really seeing anything great here with our growth to value ratios. We did turn up, but we're still below a declining moving average with the Qs to S&P, declining with discretionary to the S&P, and we're pretty much flat under a declining moving average when we look at large cap growth versus large cap value. So large caps, mid caps, and small caps are showing weakness on our growth to value ratios. What's our outlook? And please keep in mind, I don't know, you might think this is a big deal. It's something that's going to happen. It's something that does happen in the universe from time to time. There's going to be a total solar eclipse on Monday, April 8th. Is that going to affect the market? Are people going to be waiting for the mothership to come pick them up? Are cults going to commit suicide? Who knows? When these kinds of things happen, people tend to act kind of strange. Other people, like myself, just kind of go, oh, that's interesting. What's happening on Tuesday? All right, technicals are positive, and for right now, it's looking like a pullback. we see further weakness, that could change into more of a decline. And if we continue with the decline, then we might actually evolve into a correction. But for right now, as long as we're above the 20-period moving average, we are still looking like a pullback. We're going to get the MBA Mortgage Applications Index. The big one is going to be the ISM non-manufacturing and the ADP employment change. And then we want to keep an eye on all the crazy things happening in the world. And then we're going to get the employment report. And I had to update this a little bit. That's why it looks strange. Briefing.com, they must still be on break or something. They didn't even have the ISM listed on their calendar for this week. They had nothing about the core PCE report coming out. So I'm having to cross-check this with other sites that produce an economic calendar. Here is an economic calendar, which seems a little bit more reliable. This comes from investing.com, and it's free to access that. Seasonality, we're neutral to negative with the Dow and S&P. We're neutral to positive with the NASDAQ. So we're right around that 50% level currently. We do see a little bit of positive seasonality for the third trading day, which is also April 3rd during an election year. I don't know what to think of this right now. We should be going back up, and we've been going down so far in April. We were supposed to be coming down in March, and we went up. So seasonality is just kind of off to the side for right now. There's another chart put up by Isabel Net looking at April. These are the returns going back to 1950, and April ends up being a positive month. And then Wednesday is the most negative day of the week. April tends to be positive on all the different areas of which we measure it. And then the warning signs. I don't know. I think the equity put-call ratio is going up. You would think that it is because we've had 2 down days now, but that's why I have an asterisk here. The Chaikin money flow and the Chaikin oscillator are negative. The parabolic SAR, that's a big one to me. That has turned negative. The bullish percent index for the S&P, it's still above 70, but now it's declining. So it's taking on a different context. And the bullish percent index for the NASDAQ 100 is right at that 50 level. And then we have our negative divergences. The reason why I'm including the S&P 500 oscillators is because we're flatlining, but we're flatlining at extreme positive readings. And then, of course, the small caps to the S&P, discretionary to staples, that ratio is also diverging from the strength that we were seeing in the S&P. And then longer term, the transports are diverging both from the Dow and the S&P. And the momentum for the NASDAQ 100 is negative. On the positive side, the vortex is still positive, but it is trailing off and showing some weakness. Small and mid cap growth is positive, but they have been pulling back lately. Large cap growth for right now is holding up, but not really performing all that well. The financial sectors, we've had a couple of down days, but it's still in an uptrend. So our conclusion, right now, it still looks like a pullback. We'll evaluate things after Wednesday to see if they become even clearer. In the short term, we're pulling back. We're still above that shorter term and longer term overhead resistance for the S&P. We're still a little bit overbought in the intermediate term, but we continue to be positive. And in the long term, we're still looking extreme positive with our 150 and 200 period moving averages. Thank you. I really hope you found this helpful. Have a very good day, and I will talk to you in the next video.